Jeremy, should we start? Are we done? Are we ready?
Yeah, you can go ahead. I'm just looking at the participants rolling in. We've got 7 attendees right now.
Perfect. Thank you very much. And welcome everyone to the FSB sponsor session on interconnectedness, bond market liquidity, and financial stability. This is a topic that is very important for the agenda of the FSB work at the moment, especially given the events of March last year, when liquidity issues showed again how important they are for the stability of the financial system. I wanted to thank all the authors who submitted papers to these sessions. You gave us a very difficult job, as we received more than 120 submissions for these sessions, most of which were very high quality. And given that we only had 3 slots to fill, I think that makes us more selective than the American Economic Review. I will ask each presenter to speak for 20 minutes, each discussant for about 12, so that we can have a few minutes at the end of each presentation for Q&A. If you want to ask a question, please either raise your hand using the raise hand button or put it in the Q&A box so that everyone can see them. Okay, without further ado, let's move on to the core of the session. The first presenter is Adam Copeland from the New York Fed, who will tell us about the value of internal sources of funding liquidity. So, Adam, over to you.
Thank you. All right, does that work? Sharing wise? Okay. All right, so first, well, thank you so much for including this paper, especially given all the choices that you had. So this is joint work with Cecilia Caglio, who's at the Federal Reserve Board, and Antoine Martin, who's a colleague of mine at the New York Fed. Because of where we work, we have to say that these are our own views, not those of the institutions at which we work. So what is this paper about? Well, basically, we're trying to study how having access to an internal source of liquidity sort of affects a financial firm's trading behavior really during a time of stress, right? So we're gonna look at broker-dealers, and in the empirics, what we're gonna do is we're gonna look at how they adjust their balance sheet in response to what we consider an exogenous liquidity shock, which is the 2007-2009 financial crisis, right? So we're gonna focus on broker-dealers for like 2 main reasons. One is that these are really highly levered institutions, and so they're very sensitive to changes in sort of liquidity, market and funding. So this should be a first order effect for them, okay? And second of all, within the broker-dealer sort of community, we have the variation organizational form that's necessary to answer this question, in that we have broker-dealers that are standalone, right? And basically they just rely solely on market for funding or for liquidity. And then you have BHC or bank holding company affiliate broker-dealers that have an opportunity to have sort of liquidity through an internal source, like through the bank holding company. So there's actually a couple different ways that these BHC affiliate broker-dealers can get liquidity, but the traditional one that we're sort of thinking about is that basically, you know, through the depository institution, through the bank that's also part of the bank holding company, this broker-dealer can indirectly access sort of the discount window. Okay, so there's some rules about that, how these guys can access the discount window directly, but if the broker-dealer is providing sort of liquid securities like treasuries or agency debt or agency MBS, it's really not an issue. Okay. So what do we find? We find that this organizational form makes a big difference in how these guys reacted to the crisis, right? And sort of in how they sort of changed their balance sheet. And what our 2 sort of big findings are going to be, well, first of all, we find that non-BHC broker-dealers, I also call them standalone. Standalone broker-dealers basically shifted to a much greater extent than BHC affiliate broker-dealers through the use of repo and reverse repo. All right, and we're going to interpret that sort of thing as shifting towards trading more liquid securities, towards trading treasury, right? Because we sort of know that over this pre-crisis, during the crisis, and even post-crisis, repo trades are really dominated by the exchange of treasuries for cash, right? So we can see them shift towards repo, and we're going to interpret that as sort of trading more treasuries relative to broker-dealers that are part of bank holding companies. And the second big finding is we actually can see directly sort of what they're trading because we look at their long inventory. And we find that sort of standalone broker-dealers significantly increase the share of long inventory, significantly increase the share of government securities share of long inventory relative to bank holding company broker-dealers, right? So you just sort of see them shifting towards trading treasuries relative to these bank holding company affiliate guys. There's a second set of results that I personally think are sort of interesting. They're in the paper. I'm not going to have time to talk about it, but there's actually these different dynamics and how these things sort of play out, right? Because the crisis is not sort of, you know, a really short event. It happens over like, you know, a couple of years. And so what we do is we do our empirical approach is diff and diff. And what we do is we allow for there to be different effects over the first, second, and third year of the crisis. And what you sort of see actually is like On the liability side of the balance sheet, so this would be like the repo or securities lending, the effects that you sort of see, the differences between these two types of broker-dealers sort of manifest later, right? Especially after Lehman. While on the asset side, things sort of show up earlier. So I think there's some interesting dynamics that we actually could probably talk about more sort of in the paper, but I'm not going to talk about them here. Okay, so why is this important? I mean, you have this general result about these guys being different, but I think it's sort of important sort of in a sort of bigger sense. One is that what our results sort of tell us is that these broker dealers that are affiliated with bank holding companies are sort of more resilient sort of to financial stress, right? They didn't shift towards treasuries as much. And that's important from like a larger point of view in terms of like financial stability, because it means that these bank holding company affiliate broker dealers are able to make markets on less liquid securities, like corporate bonds or equities and things like that, right? And this also is currently relevant, right? Because there's a lot of talk right now talking about whether the Federal Reserve should sort of basically provide liquidity to non-bank intermediaries, which would be broker dealers, through a facility called the standing repo facility, right? So we interpret our results as providing some evidence that something like a standing repo facility would have been very helpful for standalone broker dealers sort of during the crisis, and it would allow them to sort of like not sort of move towards trading treasuries as much, and maybe provide be able to make markets for things like corporate bonds and less liquid securities. Okay. So let me tell you the outline of the talk. I have one page about broker dealers just to make sure we're on the same page. I'll tell you about the data and I'll tell you about the results. Okay, so as I mentioned before, broker dealers are heavily reliant on debt. So they have, as we all know, they're highly leveraged. And so they really rely upon sort of the liquidity and funding markets. And so before the great financial crisis, there was this sort of belief, this is my understanding from talking to people in the industry, but also sort of reading things, that secured funding was a really robust way to sort of raise funds. All right, and so I think actually even before the great financial crisis, firms were trying to move away from unsecured funding towards secured funding, because it was just the idea that if there was any sort of problem because of use of haircuts and other tools, that you'd be able to keep getting secured funding even sort of in a crisis. And what we sort of see is that in the great financial crisis sort of revealed that that wasn't quite right, and that even secured funding markets, there was this underlying fragility. So there's several talks about this, several papers about this, including one by my co-author, Antoine Martin, in a 2014 paper. And in particular, there's this really interesting sort of piece by an analyst at Citi, and the title of this piece was, "Is the broker-dealer model dead?" And I think he wrote this like in late 2008, maybe 2009, and he was sort of reacting to the fact that all the large standalone broker-dealers like Goldman, Morgan, Merrill Lynch had all switched, either had sort of gotten bought by bank holding companies or changed their structure to become bank holding companies. And this piece was just sort of saying, well, it's this idea that broker-dealers could support themselves as standalone entities with secured funding, is that out the window? Well, it's just like a big lesson we learned from the crisis. So I just want to tell you that there was this idea that secured funding was pretty robust and was what should work pretty well, and that was sort of tested, let's say, or sort of proved wrong in the crisis. The last thing I want to say is that in the crisis, the Federal Reserve took a lot of actions to provide liquidity to the market, and so in the paper we sort of detailed that. But the point I just want to make is that the Federal Reserve was really restricted in how it could provide access, provide liquidity, and most of what it did was provide liquidity to the bank holding company or to broker dealers that are part of bank holding companies. Like all the primary dealers, almost all of them are part of bank holding companies or switched. So there wasn't this idea that the Federal Reserve was going out there and providing liquidity to standalone broker dealers beyond like the 4 or 5 big guys that sort of switched, and those guys won't be in our analysis. Okay. So what's the data in the sample? So we actually use data, I think, that at once are pretty familiar to people in academia, but actually haven't been used that much. So broker-dealers file these quarterly filings called the focus reports. I just think of them as being, banks file the call reports, broker-dealers file the focus reports. It tells you a lot about their balance sheet for that quarter, and also things like revenues and stuff like that. Now, there has been a bunch of research using focus reports, but it tends to be the focus reports of the primary dealers. And so I was thinking about this, a couple weeks ago, and I think the reason for this is that researchers in the Federal Reserve have access to the focus report for primary dealers, and I think it's generated lots of research. But to get access to the focus report for the whole cross-section of broker dealers has been much tougher. It's sort of owned by the SEC and by FINRA, and I just think it's been harder for people to sort of access it. So my co-author Cecilia has been sort of like very successful, and she's been sort of she's done a really great job getting access to the whole broad, all FINRA member focus reports is what we were able to work with. So she's the whole cross section of broker dealers, and in that way, sort of our analysis is pretty novel in that not many people have been able to access or be able to publish sort of papers using the whole cross section. We layer in hierarchy data that tells us whether the broker-dealer is part of the bank holding company or not. And then we do this sort of filtering of the data. The first point, broker-dealers, subsidies of thrift holding companies, they sort of appear like halfway through our sample. They're tiny, it was sort of like a nuisance, so we just got rid of them rather than try to incorporate them into the analysis. More importantly, we exclude broker-dealers that exited the panel or came into the panel during our time of study, so we don't have to worry about selection. And then the last point is that there were these very prominent broker-dealers that switched their affiliation during the financial crisis, and we just removed them. So like Goldman, Merrill, the usual things. It actually doesn't, I don't think it's going to matter that much for our analysis because our analysis is not weighted by size. So it'll just be like, 5 or 6 more broker dealers, but I think it's cleaner from a economic point of view to remove these guys who sort of switch their affiliation. Okay. So just to give you a sense of what we're working with, this is the size of, I just summed up like their assets by the 2 types of broker dealers in our data. So you can see that they're roughly equal. The non-BHC guys are a little bit bigger. Now, one important difference is that the BHC affiliate broker dealers is like 150 or less than 200 of our sample, while there are thousands of non-bank holding company affiliate broker dealers, like 5,000 or something like that. So it turns out that that's actually, so you might worry about your sort of analysis, you're worrying having these very different types of broker dealers, but it turns out that in our analysis, we're going to really focus on things like repo and second lending and reverse repo. And it turns out that the broker dealers that do that kind of activity are a very small subgroup in terms of numbers of total standalone broker dealers. So they're larger. So it tends to be the larger non-affiliate broker dealers that do this, and there's not as many. All right. So there's this huge tail of standalone broker dealers. They're not going to be in our analysis because they don't really do that much repo and securities lending, so they're not going to be in our analysis. Okay. The second thing to sort of worry about with this sort of with this time series is that there's this huge change, right, in the time series with the crisis. There's this huge contraction, and the question is, how do you handle that empirically? So what we do is we look at shares, right? So we're saying, look, we look at the share of like repo. Repo is a share of total liabilities and how that changed over the crisis. And we think that's a nice way to sort of deal with the fact that there's this whole deleveraging with the crisis. So let me show you. Right. So this is the things we focus on. We focus on repo and securities lending on the liability side, reverse repo, securities borrowing, and government securities share on the asset side. And everything's going to be sort of normalized by like total assets or total liabilities. Right. So we're just looking at how these broker dealers are sort of devoting shares of their balance sheet towards these different activities and how it changes over time. I just want to focus on 3 things. So repo, right? So I didn't explain what repo was. I'm sorry. So repo basically is these simultaneous exchange of securities for cash. You just think of it as secured lending. So on the liability side, just think of the broker dealers trying to, an easy way to think about it, they're trying to get secured funding from various people. The difference between repo and securities lending is that repo is dominated by treasuries, while securities lending tends to involve a lot of equities, a lot of corporate bonds, and there's some treasuries there. But repo, so 40.7 means that 40.7% of total liabilities on average is devoted to repo on these standalone broker dealers. For the BHC affiliated ones, it's 45% of total liabilities. So they're pretty common sort of how much activity they're doing as a percent of total liabilities. And reverse repo, they're also very similar, it's in the 30s. Now, what's sort of interesting, and this is kind of like the heart of the paper, you can just sort of see these conditional means, is that from the pre-crisis to crisis, the standalone guys went from 40.7% to 43.4%, right? So they're increasing their repo by like 3 percentage points into the crisis. I mean, they're doing more repo, right, which we deduced to be doing more treasury trading, while the bank holding company guys decrease, right? They go from 43.3% to, I can't see it because of the, to 30%, right? So they're actually, the bank holding company guys are actually sort of just removed, they just actually shrink how much repo they do in the crisis. So there's this difference, like this huge difference between broker dealer type. You see the same thing with reverse repo. So reverse repo is where the broker dealer is going to be lending cash out and getting treasuries or getting securities from clients. And here you can see once again the standalone guys increase how much they do. Actually, they're doing more treasury trades, and the bank holding company guys are reducing it. All right. We can sort of directly observe that it's treasuries when you look at the government securities share of long inventory. So, before the crisis, they have about half, 46% of the long inventory is government securities. And then in the crisis, the standalone guys go up, 5 percentage points, and the bank holding company guys go down, 4 points. So so you can see there's a big divergence sort of in how these guys are sort of react to the crisis. Standalone guys are just doing a lot more treasury trading, and it's showing up in their balance sheet as increases in repo, increases in reverse repo, and increases in government securities share. Okay. And now the remainder of this talk is going to be like, we're going to formalize this using a diff and diff sort of approach. Okay, so we use differences. It's pretty simple. There's an indicator dummy for crisis, indicator number for your bank holding company, and then what we care about is the interaction term, which is this delta. Okay, and I want to say, yeah, on the left-hand side, we're just going to run separate regressions for repo, sec lending, reverse repo, securities bar, and government securities held in long inventory. Okay, so what are our threats to inference? So you got these two groups, your treatment and control, and you have this sort of the treatment effect. It's a treatment sort of exogenous. Well, I think we can plausibly say the great financial crisis was an exogenous event. There's questions about parallel trends between these two groups. I'm very boldly saying it's satisfied. I think the bigger picture is that for some of these variables, I think for like repo and securities lending, like parallel trends I'm very confident to say the parallel trends something holds. For these other ones, it holds. We have different cuts of the data, right? We have a propensity score thing. So over the different cuts of the data, you can make an argument that for at least one or two cuts of the data, the parallel trend assumption is going to be satisfied, right? So there's some variation when we look at these different cuts of data about how convincing the parallel trend assumption is. But I think you always find at least one or two cases where it holds pretty well. And then I want to sort of say I'm sort of satisfied with that because the empirical results are sort of pretty consistent across these different cuts of the data, right? So across the different cuts of the data, we find repo, that standalone guys move towards repo in large amounts, and for at least some of the cuts of the data, the parallel trend assumption, looks pretty good. Right? I just want to point out there are some cuts of the data where it looks a little iffy, but I guess that's just the nature of empirical work. So importantly, the bank holding company affiliation, is that really exogenous to the great financial crisis? And we sort of argue, look, these decisions were made like way before the crisis even happened. And secondly, I think before the crisis happened, people really thought secured funding markets were like super stable, super secure. So we don't think that this idea of like, oh, you want to become part of a bank holding company because of internal source of liquidity was like even important. It wasn't a first order importance in making this decision. And so we don't think that this decision about should I become part of a bank holding company or not, it would, is going to be important in that dimension. So there's that. One of the things that we got a lot of pushback on, but I think we've addressed instead is that the idea that we did this diff and diff, it looks sort of pretty clean in terms of finding its results, but what's the mechanism, right? Is the mechanism that we're identifying really internal sources of liquidity, or is it something else? And so what we, in particular, what people sort of said is that maybe there's different business models for broker dealers that are standalone versus bank holding company, and that sort of resonated with us. And so we thought, well, how could we sort of address that? And we did that through a propensity score matching sort of approach. So what we did is say, look, if these guys really have different business models, let's just try to match them. Let's try to create a match where it's hard to argue they have different business models. And so in the focus reports, we have revenue data, right? And so what we do is we create this matching where we have to say, look, are they similar in size? And is the share of revenues that they get from different revenue sources similar, right? And if that holds true, then we sort of match them together. And with this sort of matching technique, we lose like about half of our sample. But the end result is that we're much more confident that these broker dealers that we're sort of comparing across the two groups have similar business models because their revenue shares are similar and they're sort of similar sizes. Okay. I hope I'm doing okay on time. Oh no, I might be done with time. Matteo, am I okay? Or I'll just finish.
You've got about 3 minutes left.
Okay, I'm almost done. So I'm just gonna like quickly highlight. This is the propensity score results. And oh no, I'm sorry. This is our main results. Right? This is our main results for the full sample. You just look at this sort of line here where it's bank holding company versus crisis. This is the interaction terms. You can see we get these sort of economically large and statistically significant results, right? So bank holding company funded broker dealers in the crisis, that's 11.7 percentage points less repo than standalone guys. Reverse repo, much less, 12.4 percentage points less than the standalone guys. And then you can see government securities share of inventory, much less than the standalone guy. So basically, you can sort of see the results I showed you with the means are sort of coming through very clearly with the diff and diff. Okay, I just said that. This is about the propensity score, but I already told you about that. And so let me just go quickly. So it's like, what's the bigger picture? All right, so we framed these results. Hopefully, if you take as given that our results are sort of valid, that these guys are trading more, like the standalone guys trade more treasuries during the crisis, while the bank holding company affiliate wants to trade less, then how is this relevant for like the bigger picture stuff? And I think it has relevance for this policy debate about standing repo facilities. All right, so this is something that our former president of the New York Fed talked about, Dudley, and more recently, there's this paper by Liang and Parkinson that sort of heavily pushes this idea that the Federal Reserve should sort of increase market liquidity to non-bank intermediaries during times of stress. And I think our results sort of point that this is, there is some value to this, right? Because in the crisis, standalone broker-dealers just sort of move towards trading treasuries. And the downside of that is that they did a lot less sort of market making in sort of illiquid securities like corporate bonds. And that was like a really big concern during the crisis. That we want all these markets to sort of function. And if broker-dealers are unwilling to make markets, these markets will sort of collapse. All right, so sort of one benefit we think of having a repo facility is that it'll sort of support all these other markets of less liquid securities that we like to function during times of stress. The last point is like, well, look, you don't just provide some benefit without there being some cost. I think this is sort of less trickier, but we sort of on a note that if the Fed were to expand and allow sort of non-bank intermediaries to have access to liquidity, I think the Federal Reserve, of course, would want to have some sort of like oversight. So I don't have anything to say about that. I just want to sort of point out that you don't get things for free. Okay, so let me conclude. Let me just conclude. All right, so if you read our paper closely, you're going to sort of see broker-dealers not affiliated with bank holding companies pretty dramatically restructured their balance sheet relative to their BHC-affiliated broker-dealers during the crisis. They traded a lot more treasuries. And we sort of think our results sort of point to, there definitely might be benefits providing liquidity to standalone broker-dealers in times of stress. All right, thank you very much for listening. Oh, I'll stop.
Thank you, Adam. Thank you. My colleague Harry is going to discuss your paper now.
Hi. So can everybody hear me?
Yes, we can.
Excellent. So hello, everybody. My name is Hari Phatak. I am indeed one of Matteo's colleagues at the Financial Stability Board, member secretariat here. I don't really have a disclaimer anymore. I used to have a disclaimer in my old job. I don't have one in my new job, but I'm very pleased to discuss Adam's paper on internal sources of funding liquidity, and I'll try to keep this short. So there we go. So just quickly, what did I take away from the paper? I feel like Adam has summarized this well already, so there's no point in dwelling much here. But organizational form matters. So how a broker-dealer is organized, whether it's a standalone entity or as part of a bank holding company, partly determines its access to funding, and that access to funding has implications in a liquidity shock. And so the authors present evidence of this. Again, Adam did a great job of summarizing his own work, so I'm not going to dwell on this, but he was able to show that there are significant changes in the composition of broker-dealer balance sheets in the presence of a liquidity shock for those broker-dealers that are organized as standalone broker-dealers relative to BHC-affiliated broker-dealers. And they tend to tilt their balance sheets, so standalone broker-dealers tend to tilt their balance sheets towards intermediating more liquid claims, so treasuries in this case. So again, quickly on their empirical approach, again, don't need to spend much time here since Adam really covered it, but the authors regress these balance sheet variables on indicator variables that summarize the organizational form of broker-dealers and crisis versus non-crisis periods. And their data source is interesting. So this is the FINRA focus data. As Adam mentioned, it's been used by academics in the past. It's very difficult to come by. I'm somewhat familiar with it. My old affiliation was with the SEC. And I know that it's actually a pretty rich source of information about broker-dealers. And it has pretty good coverage across all registered broker-dealers. So it's the kind of thing that I'm excited to see used by research. I wish there were better access to it so that it could be sort of applied in more settings. But But for the purposes of Adam's work, the main variables of interest are, information about broker-dealer balance sheets, and then information about the different business lines of broker-dealers. And so they're able to see, I think, revenue shares across different business lines, and that's helpful for their propensity score matching. So as I read the paper, there were certainly some questions that came to mind. I thought that one of the things that struck me was that the authors and Adam presented the full sample results. So the regression results based on the full sample of broker dealers. They also repeat those regressions with the propensity score match sample. And one of the things that's notable there is that the direction and more or less the magnitude of coefficients stay the same. So that the results, the magnitude of the results is robust to moving to this propensity score match sample. But one of the things, the match itself seems to remove a lot of observations, at least looking at the regression tables. And my sense is that since the authors were matching on size in addition to these share variables, there were probably some of the sort of marginally smaller marginally smaller standalone broker dealers that were being dropped from the sample. And I think that one, potentially interesting thing to look at would be the characteristics of these slightly smaller broker dealers that ended up not being matched. Just to understand what is driving their change in shares. So that would be one potential avenue to go down. Of course, when we look at papers like this, it's always tempting to think about other alternative explanations for the effects that we're seeing. And the authors do a really good job, I think, of laying out the threats to inference. And they provide really reasonable arguments for why those threats aren't really that big of a deal. So one alternative explanation I'll offer, and this is just in the spirit of trying to be constructive and maybe provoke a little bit of debate, is whether some of the effects might be related to non-BHC or standalone broker-dealers' position in dealer networks. And so what I have in mind here is that if we believe that these non-BHC affiliated dealers tend to be on the periphery of dealer networks, then they may prefer to intermediate in sort of less informationally sensitive markets when volatility is high, so in crisis periods. And so in addition to the access to internal funding or lack of access to internal funding for these standalone broker dealers, this might be another contributor to their shift towards treasuries, so less informationally sensitive securities. So that would be one thing I'd offer as a potential additional factor to consider when you're examining these markets. And then finally, at the FSB, I think one of our major roles here is not as a producer necessarily of good academic research, but as a consumer of it. And so we're always interested in seeing what papers can teach us about current topics. And so, in the context of the most recent financial crisis or the COVID crisis, I think that one interesting path that you could go down, or that we could all go down as a profession, is to think a little bit more about how persistent these changes in balance sheets were. And so you could imagine that, once the availability of external funding became more certain post-crisis, that the differences between these two types of broker-dealers should narrow. And so, I think that extending the sample and looking at how those balance sheet shares evolved through time might be of interest as well. And just trying to understand whether the changes that we observed post-crisis, or the changes that the authors observed post-crisis, are things that have remained. You could also kind of take the analysis a step further, and you've taken this to look at look at dealer balance sheets. Now, would you take that one step further to think a little bit about what that means for market liquidity? And in particular, as we've seen non-bank dealers playing a more prominent role in government bond markets? Does their reliance on external liquidity, or external funding rather, make liquidity in these markets more resilient or less resilient in times of stress? And then finally, on policy proposals, I'm really glad to see the reference to standing repo facilities. This is, I do buy the argument that their empirical results supports improving access to, or broader access to standing repo facilities at the central bank. The other thing that I add here too is that I think that your analysis supports measures to make more efficient use of funding. And so here I'd say or I'd add that the analysis supports measures that could help non-bank dealers make more efficient use of the liquidity that they have access to already. And one of those things could be central clearing for treasuries, right? So allowing them to take advantage of netting benefits. So that's all I have for my discussion. I'll stop there. And I guess I'll turn it back to Matteo.
Thanks, Harry. Yes, you gave us back a couple of minutes, so it's good. Adam, do you want to react to what Harry said? And then there's a few questions both in the Q&A and a couple in the chat, and then I'm going to add one of mine essentially.
Okay. Well, thank you so much for taking the time to read the paper that carefully, and I sort of appreciate all the comments that you've made. Yeah, we could probably do more on. I agree that we've had discussions with the co-author about the matching process and how much we report, and sometimes we get pushed back that it's just not that interesting. But we could probably put stuff in the appendix, right, about sort of the matching and how well it works. It definitely removes a lot of observations, and I don't actually. It's embarrassing to say I don't really understand like who's in and who's out. So I could look at that more. One thing I do know is that there are a lot. I don't think it's so much the size. There are a lot of small bank holding company affiliate broker dealers in our sample. So I feel like size may not be the issue. So maybe it's the revenue shares. I think that's really interesting about the information sensitivity. I really hadn't thought about that at all. And I'm not sure I can identify one versus the other. So I'll have to think about that some more. I have to think about that some more. I mean, so the biggest guys are removed from our sample. Like I said before, like the 5 biggest broker dealers, Goldman, Merrill, Morgan, they're not in our sample actually, and you think those guys would be in the center. So, but we can look. I could look more at this and figure out like, do we just have everyone in the periphery and we're looking at them? So that's a really good point. And I'll think about that more. The permanent versus transitory. So it turns out that we're thinking about writing a second paper about what happened post-crisis. And what happened post-crisis is there's a huge difference in regulation across these two types of broker dealers. So I don't think we're able to say like what's permanent versus transitory, because these guys are sort of facing very different constraints now, where the guys who are part of bank holding companies are just, they face all these different regulations that the standalone guys don't. And so I think it's a really interesting question about how regulations have affected these two types. But I think it sort of makes it very murky about what's driving what. So we'll have to think about that. Yeah, central clearing. So I know a lot about central clearing. I have not thought about it in this context. That's a good point as well. And so there were also 2 questions in the chat that I was looking at.
Yes, the first from, you can read them yourself, essentially. I don't think that everyone can see the one from Caroline. I think that's only addressed to all panelists, so you might want to read it first, or I can read it for you, whatever.
No, I can read.
Yeah.
So Caroline asks, to what degree did Section 23 exemptions play a role in the BHC ability to provide us liquidity? Can one look at different behavior with respect to when exemption letters were issued? So my understanding of I don't know. So I don't really know the details of this. So I guess we should look at this generally. But my general impression is that in the crisis, bank holding companies were given lots of leeway, unofficially and officially, to provide liquidity to their entities. All right, we were pumping liquidity. The Federal Reserve was pumping liquidity into bank holding companies with the hope that the liquidity would spread across the whole financial system. So I don't really think there was much in the way. So I really think there was it was very easy for bank holding companies to provide support for their broker-dealer entities. I'm not sure we're going to get much action in terms of like these exemptions, but I should look at that more carefully. Right, the theme in the crisis is that the Federal Reserve pumped liquidity into the people it could with the hope that it would spread out to everyone else. And it didn't really do that. And that was like a big puzzle on like, how do we get around this? Now, it's a really nice question by Yiming. Well, like, what do you think? Why did broker-dealers become affiliated with bank holding companies in the first place? If it's not about internal liquidity, that's a really good question. Honestly, I think back before the crisis, it was like a regulation question. Like Goldman and Morgan were like, we don't want to be supervised by the Fed. So it was like avoiding regulation and stuff like that. But I think bank holding companies wanted to have a broker-dealer inside because there are some synergies and whatnot. But I could probably find out the answer to that question more clearly, and we should do that. So I will get back. I will start talking to our little experts at the Federal Reserve and see what they say about this question. And there was now another question by Angela.
And then we also have one question on the Q&A.
Okay, is a standing group of facility justified because broker-dealers are making the market or generally to support financial assets in times of stress? Oh, I don't. So it gets hard for me to talk about this because of where I work. I don't.
Okay, I admit it may be an unfair question.
There's a lot of public debate about this now, where people in the Fed are talking about this. I just sort of view this as like the Federal Reserve is continuing to have discussions about how to provide liquidity to non-banks. Right, and it's just been puzzling about this, and then there was pushback from Congress after the crisis about you guys did too much. So I think I just sort of view it as we're just trying to figure out our way forward and what the benefits are. So too bad. I wish Antoine Martin was here. He'd probably have a much more coherent answer about this. So yeah.
Thank you.
And do you want to answer the question in the Q&A from Aye Bande Amadi, or can you see it? Or
I don't know. I don't see it, but maybe I'm not.
So I'll read it for you then. So okay. Following the great financial crisis, we also saw treasury trading become more susceptible to flash events and disappearing liquidity as market making those markets shift further to high frequency electronic trading. Any thoughts on how this might interact with the model and the results?
Yes. So actually, I have a paper with Daryl Duffy that kind of talks about Daryl Duffy and David Yang about this. I kind of feel like it's a little bit of a different issue where, so I don't really know if it's electronic trading per se that's causing these problems. So in the paper, what Daryl, David, and I argue is that the broker dealers that bank holding affiliated have plenty of reserves to make markets. They have plenty of, they got these reserves, they could make markets, but they're constrained by other things. They're constrained by sort of, so I can say, so I'm sorry, I took that. It looks like they have plenty of reserves to make markets, but they actually don't because they have all these constraints on these reserves and how they can use them. And in particular, these reserves have other uses on their balance sheet and they're not willing to make markets. So I don't think, so the short answer is I don't think this is a question about whether they're bank holding company affiliated or not. It's about like how much reserves should the Federal Reserve provide to the system given all the regulations that we have, right? So we put all these regulations of bank holding companies, it makes reserves valuable to them. And then the question is, given all that, how much reserves should there be in the marketplace? And we're arguing that despite that it's like $1 trillion worth of reserves, it's not enough, right? So my answer is I don't think this paper speaks to that directly. I feel like it's a different issue about the reserves in the system correlate with all the regulations that we've imposed on them.
Perfect. Thank you very much. I can't see any other question. I'm gonna ask you mine, which is more of an observation than a question, which is when you said that you're not incorporating information from those dealers that change from being affiliated to being unaffiliated or the other way around, I think that would give you some idea of why these guys are making the change and what some sort of exogenous variations ideally on how the impact might be different. Although clearly you need to establish first that the change from being affiliated to unaffiliated is exogenous in the first place. So you might want to think about how you can use that change as an identification variable, essentially.
Okay. All right. That's the point.
Perfect. Thank you very much, everyone. Let's now move to the second paper on the program, and we have Angela Maddaloni from the European Central Bank. And she's going to talk about liquidity support and distress resilience in bank-affiliated mutual funds. Angela, over to you. Angela, you're muted.
Okay, here I am.
We can hear you now.
Can I go? Okay, I made it. Okay, can you see it well? Can you hear me well?
All good, please go.
Okay, so thank you very much for including our paper in this session. Actually, as you will see, I mean, I congratulate the organizer of the session because, as you will see now, I mean, this paper in a way contains the topic that was already discussed in the first paper. So in this work, what we look at is liquidity support and distress resilience in mutual funds. So we are going from broker-dealers to mutual funds. This is a joint work with Giulio Bagattini and Falko Fecht at the Frankfurt School of Finance and Management. And of course, I work at the ECB, usual disclaimer apply. So very quickly, why there is a problem of, there might be liquidity distress in the mutual fund business, mainly because open-ended mutual funds, they issue liquid fund shares, and these liquid fund shares are backed by a portfolio of potentially illiquid assets. So of course, liquidity of the asset can change, and in some instances, they may become quite illiquid. This implies that in times of stress, mutual funds are vulnerable to large redemption. So you can have a lot of redemption, and of course, the value of the funds decrease quite abruptly. At the same time, it's important to look at liquidity support within financial conglomerates. And as I said, this is very close to what was seen in the previous paper. If we look at the mutual fund industry in Europe, pretty much half of mutual funds belong to banking groups. Also in this, there is quite a lot of literature looking at the relationship between banks and affiliated funds and how they support in times of stress or normally. What we will look at is more what happened at this kind of relationship in terms of liquidity insurance in times of a crisis, or when there is a big shock. And so again, we have this idea that banks are the investor of last resort, that are ready to bail out the mutual funds that are affiliated in the banking group. Okay, this is just a couple of articles that refer to the latest crisis, of course. They refer to money market funds. We don't really focus on this area. We focus in general on the mutual fund industry, but just to motivate. We have seen this happening also in the most recent months. So the first question that we ask, and we provide an answer, is do banks provide liquidity support to distress affiliated funds? Are investor flows at the European bank affiliated mutual funds more stable than at affiliated funds? So this is in general provide this insurance provides some stability to the funds flow. And then we look at some exogenous shock, and I will talk more about it, and how in this kind of instances, when there is a shock, actually what is important is also the financial position of the bank and the health of the bank. So let me start to say something about the data, because this is actually one of the most original contribution. So we use the ECB securities holding statistics data, and we have proprietary holdings of investment fund shares for the 26 largest European banking group. So for this 26 European banking group, we know the portfolio at the security level, and we can identify what is their investment of mutual fund shares, really at the security level. We match this with data from on the mutual fund industry that we get from the Lipper database, which is a market provider. And then we have a series of additional data sets, in particular from the banking side. We use some of also supervisory data on the European banks. Here, as I said, we have data only for the 26 biggest euro area banks, but they are from pretty much most of the euro area country. And they hold a total of more than 50,000 mutual fund share classes. And on aggregate, affiliated funds make up between 40% and 67% of the bank's portfolio of mutual fund shares. So let's say half of the portfolio of mutual fund share that banks invest in is on the on shares or affiliated funds. As I said before, about half of the mutual funds that we are domiciled in the EU are affiliated, and overall there are around 30,000 mutual funds. And okay, we do some trimming of the sample. We focus on funds that are at least 70% owned by the retail investors. So let's see. I mean, the first part of the analysis, we analyze the question: do banks support affiliated funds by buying shares? And in order to do this, basically we estimate this model in which on the left-hand side we have what we call bank trade, which is basically the increase or decrease in holdings of the mutual fund share of a specific mutual fund. And then we control for the fact that this mutual fund is affiliated or not to the banking group. And we also look in particular what happened in distress. And we define distress as, an instance in which there is a very high level of redemption, a lot of outflows from these funds. So these are the first results. So we concentrate in particular on the coefficient of the interaction. So you can see that when, in general, we have that in case of distress, banks increase their share of affiliated mutual funds. And they do this also controlling for a series of fixed effects. What is interesting to look at is that the role that capital already plays in that. So if we look, if the bank, we have some definition in the paper about high capital, low capital bank. So if the bank is also a bank with high capital, this also contributes to increase the investment in fund share of that specific bank. We also look at what happened during the crisis in March 2020. So the first quarter of 2020. And we see that basically our results are confirmed. Also, when an exogenous shock hit the industry, then actually banks stepped in and increased their holdings of mutual funds affiliated with the banking group. Interestingly enough, when we try to look at the risk of the bank, in this case the bank, the headquarter bank of the group, we see that if the bank had high risk, which is proxy in this case by the CDS spread, then the holdings of the share was relatively lower. So already from this first result, we see that affiliation definitely implies some sort of liquidity insurance from the point of view of the bank towards their affiliated mutual funds, but at the same time, banks intervene more when they have a strong financial position. We have looked at capital and their CDS spread. So as I said, when affiliated funds experience large idiosyncratic outflows, banks purchase their share, and the results hold for the COVID-19 systematic shock. Banks support affiliated funds when they have strong financial position. And of course, I think we can also say that this is not just contrarian trading, because of course, in that case, they would possibly buy both affiliated and non-affiliated fund share. I also want to say that this part, when banks purchase their share, is one channel that we identify of banks sustaining mutual fund share that has not been addressed in the literature before. I guess also because of the lack of specific data that we use. And then briefly now, I'm going to say something about if affiliated funds are more stable. And in order to check this, basically we look at the volatility of flows of affiliated funds, and we also look at the returns of these affiliated funds. And here, very simply, we see that affiliated funds have, in general, lower volatility and tend to have higher return. So again, this would suggest that there is this insurance that banks are providing. It's somehow recognized because the returns of these funds tend to be higher and they tend to be more stable, having less redemption on average. Now, the last part of the paper, we look at two exogenous shocks to identify better our results, if you want. And we look at two different shocks that happened before the COVID, if you want. And okay, the nature is also different because, of course, the COVID shock is a global shock, while we use two shocks that do not affect all the funds at the same time. And in particular, we studied two episodes of distress. What are these two episodes? The first one is a tension in the Italian sovereign bond market in May 2018, after the appointment of a new government, and which was perceived, there was some information leakages at a certain point, and there was an increase, a fear among market participants that actually this government could push for Italy to leave the euro. And this, of course, reflected right away in a sudden increase in the sovereign spreads of Italy sovereign bond. So we consider this shock, which of course is specific to funds that had exposure to this market and to these assets. The second shock that we consider is the Brexit referendum in June 2016. Again, this is, it was sort of unexpected, at least it was perceived to be unexpected by the market, so considered quite an exogenous shock. And it hit in particular investors that were exposed to the UK economy. Here, I think I'm going to show only the. How am I doing on time? Sorry, Matteo.
You've got about 6.5 minutes left.
Okay. So I still have time. So I may show also the Brexit results, but okay. For the results related to the Italian shock. So what we see, first line, you see the coefficient of the interaction of a time dummy, of course, which is when the shock hit the market, and a variable that measures the fund exposure to this to the Italian sovereign market. Okay, and you see that in general, of course, this implied that there was an outflows from these mutual funds. Then we consider like a triple interaction in which we consider a series of different variables. So let's look first at affiliation. So in the case of affiliated funds, funds that were affiliated but basically were exposed to the Italian market, they had relatively more flows. So they suffer less outflows, if you want. At the same time, we see that these are the variables that I'm considering now refer to the bank. So if these funds were affiliated to a bank with a good capitalization, a high level of capital, then again, these funds experience less outflows than the other. This is true when the banks had a high level of capital and a high level of liquidity. When we look at the high CDS spread, which is of course a risk measure, we see basically the converse result. And sorry, I don't see something. Yeah, the other interesting result is when we look at banks that are actually incorporated in Italy, and we find a negative coefficient. What does this suggest? That banks basically can support their affiliated funds if they have a good capital liquidity position, a good financial position, but also if they were not exposed themselves. So, of course, in Italian banks, I mean, we all know what is there are very tight link between Italian banks and their portfolio holdings in Italian sovereign. So when the banks was an Italian banks headquartered in Italy, basically had a direct exposure to this shock, and in this case, the support for the affiliated funds was lower than otherwise. So, all in all, I mean, let's try to wrap up the results. Financially sound banking groups help affiliated funds exposed to a negative shock to better withstand distress. But at the same time, mutual funds with an exposed parent bank are also subject to outflows, even if they do not have a direct exposure to the shock, because in that case, basically this insurance provided by the bank would not be enough to countervail the outflow due to the shock and the distress. So the results of the Brexit referendum are in the same spirits. We do the same kind of analysis, and we look at the exposure towards the UK economy. So I will conclude now. And so what are our findings? Affiliated fund managers and investors rely on the safety net provided by the parent bank. And as a result, affiliated funds are less vulnerable to redemption. But on the other hand, funds are possibly affected by the parent bank's own negative shocks. So basically what we uncover here is, if you want some, on the one hand, in a new channel of liquidity insurance within financial conglomerates that bring benefits to financial stability. And as I said before, I mean, we uncover a specific channel, which is this channel of direct purchase of mutual fund shares that has not been uncovered in the literature before. However, we also underline that this interdependence implies some risk due to the connection in the group that may enhance financial stability risk. And with this, I will conclude. Thank you.
Thank you very much, Angela. Your discussant is Melina Ludolph from Humboldt University in Berlin. Melina, over to you.
Thank you very much. So yeah, thank you very much for this opportunity to discuss this very interesting paper on liquidity support and distress resilience in bank-affiliated mutual funds. So as Angela explained very well, I think she and her co-authors identify novel channels of contagion between banks and shadow banks by analyzing security holdings of the 26 biggest systemically relevant banks in the Euro era for the time period between the end of 2013 and early 2020. Thereby, they find that parent banks purchase fund shares of affiliated funds when other investors make large-scale withdrawals and thereby provide liquidity support to those affiliated funds. They also find that those bank-affiliated funds are typically associated with less volatile flows and have a weaker sensitivity to negative performance. Angela and her co-authors then argue that this is likely a consequence of those liquidity supports through this channel of buying into affiliated funds. Interestingly, they find that this effect is actually sensitive to the bank's financial soundness, in particular, I believe, capitalization and liquidity. And they also find that this, the willingness or the capability of parent banks to actually support their affiliated fund with liquidity is to some degree limited with respect to the number of affected affiliated funds. So there seems to be a limit when a lot of affiliated funds are actually seeing those large-scale withdrawals, then parent banks are not able to fully support them by providing this liquidity. And last but not least, they also find that negative shocks to parent banks can spill over to the fund, particularly by parent banks deleveraging by selling particularly affiliated fund shares rather than fund shares of unaffiliated funds. Okay, so obviously this is a very well advanced paper with a timely topic, and I think it gives a better understanding in how we can see contagion, but also support between the banking and the shadow banking market. And I mostly enjoyed that it really took many different perspectives on the topics and didn't just focus on one particular direction of this support possibility. So I will jump right into my comments and questions that came up when I read your paper. So first of all, I would obviously raise the question of causality, since you're using contemporaneous data, quarterly data, both for bank and non-bank flows. I can see why simultaneity might not be an issue, and I'm no expert on mutual funds and how their business operates, but I would at least like to have seen a discussion on the topic of causality and raise the question of, isn't there a possibility that banks actually purchase fund shares? This might then result in fund managers buying into assets or securities or whatever, which would result in a security price increase or asset price increase, which I believe has been shown in previous research that mutual funds can have this impact on markets, which would then in turn result in an increase in the net asset value. So I would at least make the argument, isn't there a possibility that investors simply use this moment when banks provide liquidity to cash out? So it might be simple to argue against it, but yeah, I kind of missed a discussion of the causality issue since I think it's not fully addressed by your empirical model, although you obviously use your exogenous shocks, but still for the baseline findings, I think it falls a bit short on that topic. As I mentioned earlier, I really liked your sensitivity analysis, and I would suggest or ask if there's a possibility to further extend it. So in particular, I think it would be interesting to see whether this support channel depends on factors like bank size, like if banks are particularly large, do they engage more in this liquidity support? And more interestingly, even I think with respect to the business model, to better understand what is motivating banks, right, to engage in this kind of practice. So is there a possibility to see whether your results are sensitive towards the loans to asset ratios of the banks, for instance? And also, I think the interconnectedness with the fund might be a factor that could be interesting for a sensitivity analysis. So I'm not 100% clear on how you could measure that, but what came to my mind was if those affiliated funds already are very interconnected with their parent banks, also through their business model, then this might be even something that further increases the parent bank's willingness to support the fund, right? And most interestingly, I believe would be if this depends on the quality of the fund. So do banks differentiate between affiliated funds that have a good past performance and those that perform poorly? Because otherwise, I think this whole mechanism kind of calls into question really the motivation of the parent banks, to which I will get back in a minute. Just one more small thing regarding sensitivity and robustness. So you show this figure in your paper, and you can see this where we can see the market value of shares of mutual funds affiliated to holding banks in the brown line, and to unaffiliated funds in the blue line. And we can see this sharp increase for the affiliated fund in the third quarter of 2018 in this market value. And I couldn't find any discussion of that in your paper. So I wondered, what does it explain? Like, where the reason for that, and also can it affect your results in any way or distort them? And next, as I mentioned before, I think my main criticism really, or suggestions for improvement rather, is your discussion of your results and the interpretation, right? So I think in your presentation today, you coined it a bit less positive, but when I read your paper, I went away with the feeling of, okay, you call it a positive spillover. You say that the fact that those affiliated funds are less volatile despite lower cash buffers, and that they show a lower sensitivity to the affiliated funds of the affiliated funds to the negative performance, are both kind of those positive effects, which I would actually argue against, since in my intuition, shouldn't less well-performing funds actually hold higher cash reserves, and shouldn't they be associated with a higher risk? Isn't it to some degree simply a crowding out effect of liquidity rather than really just a support? So from a stability point of view, I would call this positive spin on this finding into question, actually. And as I mentioned earlier, I would also be interested in a deeper discussion of the motivation of the banks. I understood that you basically argue that they provide this liquidity to stabilize affiliated funds. However, previous research has found that affiliated funds typically underperform unaffiliated funds, and I believe you in your paper find this as well. And also there's a large literature on the conflict of interest, right, between affiliated funds and banking business. So I would at least like to see a discussion of the possibility that those banks really just support those affiliated funds to support other banking activities through those possibilities due to this conflict of interest. And if that really is the case, then I think your findings actually strongly suggest that this is a practice that should not be promoted in any way. And last but not least, the negative spillover effect you find, so that banks sell affiliated fund shares, in particular when facing negative exogenous shocks. I think you argue in your paper that in this deleveraging effort, they choose to close those positions on the affiliated funds rather than the unaffiliated ones because they are simply larger, which I kind of couldn't follow why this would be a sufficient explanation, or what the motivation for the banks to really then just deleverage or use their focus their deleveraging on those affiliated funds, which would again then come back to my earlier point. Isn't there maybe an alternative explanation that those banks have a superior insight into their affiliated funds and are aware of the fact that they are typically underperforming unaffiliated funds, and therefore decide to close those positions in time of crisis rather than those where they would rather expect some positive returns in the future? And I've got some couple of other just minor points regarding the minor points in the paper. I'll send you afterwards. So thank you.
Thank you, Melina. And Angela, do you want to quickly respond to the Discussant?
Sorry. Yes, thank you very much, Melina, for all these comments. Okay, let me start from the first one about reverse causality. I'm not sure I understand completely. Okay, one point you made, of course, we are aware that there might be some issues there. That's why we introduced the shocks in the paper. I mean, that's an obvious way to control for that. But also, I just wanted to clarify that when we look at the purchases of the banks of mutual fund shares, we always look at nominal holdings. So it's not the valuation effect. So it's really that they purchase more shares. So I was not sure when you did these things of the valuation. I was not sure. Of course, I mean, you repeated this several times. I think was one of the main line of comment. Why banks do this? I mean, this is a point. It's true that there is a lot of literature on this. I mean, about conflict of interest, the fact that banks basically induce their clients to buy shares of specific mutual funds that are affiliated. So I mean, these are results that are already in the literature. We would not be able to actually look into this in particular, given the data that we have, because we do not have like data that link somehow this kind of, the clients of the banks with the mutual fund shares. So this is not something we can check. Of course, some of your comment, I think we have looked at it. Maybe it's not so clear. We have done a lot of robustness. Maybe it's not so clear in the text about the different characteristics of the banks. Some of them, of course, are difficult to look at, like bank size, because, for example, the banks that we use for the portfolio holdings, these are all very large banks. So size, it's a bit not so meaningful in that case, because they're all very, very big banks. We control somehow for the quality of the fund style, I mean, with some fixed effect, and in some of the different estimation. So yeah, that's what I mean. Thank you very much. I think we can probably try to pinpoint a bit more why banks do this, with some, mentioning the literature up there, and maybe thinking, okay, what if we can say something more. Thank you very much.
And Angela, there are a couple of questions in the chat. I don't know if you can see them. A couple from Yiming and one from Caroline. I can read them out for you if you can see them.
Okay. Okay. Similar.
First one is from.
What do you think is?
Right.
What do you think is driving this network affiliation? If it is so beneficial for funds to be affiliated with banks, why don't all funds affiliate with the highly capitalized banks? Well, I don't have an answer. There might be a lot of different reasons also linked to some sort of regulation. Not all the funds. I mean, we look at the mutual funds industry in the EU, and for example, I mean, we have some mutual funds that have exposure towards markets that are not Euro area and not EU, and so affiliation may make more sense for certain funds that specialize in certain business. So I would say it's related to the fund style or their business model. Then, Sorry. The interpretation of the direct support is a bit subtle. In theory, if investors expect there to be a bank buying share in bad times, then the incentive for them to run should be eliminated to begin with. In turn, the bank should not need to buy any shares, okay? The fact that we observe direct purchases by banks may then mean that the expectation channel did not work well to prevent investor outflows in the first place. Yes, I guess that's what we have in mind, this kind of mechanism that we have in mind. As I said, I mean, what we uncovered that there is this very important implication due to the financial position of the bank. So this is not something that eventually is probably observable necessarily ex ante from investor, I would say. So what we observe is that in the case of a shock, if banks do not have a strong financial position, they would not intervene. So probably this prevents this kind of assessment from investor, or in any case, affiliated funds will be supported by the banks in any case, because that's not what we find basically. And okay, a typical result is that institutional investors run more quickly than retail. So how does the restriction to funds with 70% or more retail investor affect your result? This I haven't thought about it. So sorry. In general, we have institutional investors run more quickly than retail, of course. Okay. If this basically doesn't take into account institutional investors, it may have it may have some implication on this, but we haven't thought about it much. So I don't want to say things I'm not sure of. And did affiliated funds also tend to have higher liquidity mismatch? Did they hold more illiquid assets or lower cash balances? Yes, I didn't say that. I think Melina hinted in her discussion. Yes, we found these results. They tend to hold, they tend to have lower cash balances, which would suggest, or at least that's what we interpreted. I mean, Melina was saying that she doesn't, she sees it in the other way around. But the way we interpret is they hold lower cash buffers because they know that in the case they need cash, they can go to their basically bank holdings companies. But again, these are results that have been uncovered also by in other papers, I believe. And there is also one question in the Q&A, which I can read for you, which is, does bank support discriminate more than the market on health of the fund when purchasing or providing support? No, not really. We don't find that, I think. No. So more, I mean, more than the market. So like that the banks, in a way, yes, because I mean, banks are intervening when there are strong distress and outflows from the fund. So in this sense, yes, but I'm not sure I understand the question then, because this is basically what we show. So when there is distress in the market, there is outflows from these funds, which means that there are some investors that are running from these funds. And then we observe that actually bank holding company buy more of this of the share of the affiliated funds. Okay, thank you. I think we went through the list of questions we had, so we can move to the third paper on the agenda. Thank you. And we have Yiming Ma from Columbia University on a paper on mutual fund liquidity transformation and reverse flight to liquidity. So Yiming, over to you.
Thank you very much. All right.
Yiming, you might be muted.
Okay, now you can hear me. So I just wanted to say thank you to the organizers for having us on the program. You know, as you see from the flow, this paper is also going to be on mutual funds. And in particular, we're going to look at the COVID-19 crisis and, you know, the effect of mutual funds there to tell us a bit about, you know, what might happen to this industry and its implications going forward. So this is joint work with my colleague Kairong, Xiao, and Zeng, who is at Wharton. Okay, so this paper started with a very simple observation, which is that, you know, usually we think of a flight towards liquidity in bad times, right? So meaning, you know, world gets bad, everybody wants to buy into liquid assets and safe assets such as US Treasuries, right? Prices go up, yields go down. So that's what you see on this graph. You know, as the VIX index spikes, indicating bad times, you see a drop in the 30-year Treasury yield where, you know, every dot here is basically a day in time. Now, this trend reversed in the recent COVID-19 crisis. So in red, I have days representing the second half of March and the beginning of April. And what you see is that as the VIX was spiking, so on worse days, the Treasury yields were increasing rather than decreasing, meaning that there must have been a lot of people trying to sell, sell these Treasuries, which usually, you know, you would think there should be a net pressure to buy in bad times. Okay, and so this spiked a lot of work. People who've looked at these liquid assets markets, such as US Treasuries and investment grade corporate bonds, during the COVID-19 crisis. And there's also been a lot of work thinking about, you know, why didn't dealers, right, go in and lean against the wind, right? Why didn't the dealers come in? And the idea there was, okay, dealers are constrained in their balance sheet, you know, also echoing the previous two papers. And what this paper is going to go ask, and is they say, well, but who sold these treasuries to begin with, right? Who sold these liquid assets to begin with that created that net selling pressure and that disrupted the liquid asset markets? Okay, so this is going to go take a look at one, what we think important contributor to the selling pressure, which is fixed income mutual funds. Okay, and so fixed income mutual funds are special in the non-bank sector because they do liquidity transformation, right? They have liquid shares on their liability side, and they have a portfolio of mostly illiquid bonds. Now, that liquidity transformation amplified the outflows from the fund, which then triggered the funds to sell assets. But the assets they sold were not just random assets. They followed a pecking order of liquidation by which they were selling their most liquid assets first, right? So they keep liquid assets as a liquid buffer, and in bad times, they got rid of the liquid buffer. Now, problem is that everyone tried to get rid of that liquid buffer at the same time, which led to a concentrated sale of liquid assets by the entire bond mutual fund sector, which in the end was so big that it strained liquid asset markets. Okay, and we find that just in terms of the size of this, as a sector, mutual funds liquidated 236 billion in treasuries in the first quarter of 2020. And this was about a third of the total treasuries liquidated. And this is also the largest amount that any financial institution has liquidated. Okay, so we think of them as an important contributor, and just some broad facts backing up the story I just told you. First, we find that more illiquid corporate bond funds had larger outflows. Right, and here you can see the yellow curve is loan funds. High yield bond funds are the green curve, right? These had much steeper outflows than, say, the investment grade bond funds and the treasury funds themselves. Okay, so there's something about that illiquidity. But now you may say, well, you know, maybe high yield is also more risky, right? And they were more exposed to the COVID-19 crisis from a credit risk point of view. Well, if that is true, right, if it's just a credit risk story, then we should not have observed that equity funds, right, which arguably are much more risky, right, because equity versus bonds, right, they actually had very muted outflows. They also had outflows, but it was nothing like what we've seen at bond funds, you know, where the total outflows, you know, if you can see this along, you know, the historical trend was way beyond what we've seen before. Okay, and so what we conclude from the combination of this graph and this graph is really that it's the liquidity transformation that has induced the amplified outflows, as also mentioned in the literature, because of these first mover advantages in taking money out of the funds. Okay, so large outflows due to liquidity transformation, and then it's the concentrated sale of liquid assets first. Right, so here I'm plotting by different ratings and for treasuries the percentages liquidated by mutual funds, and you can see that the highly rated bonds were sold at a larger proportion. Okay, so this would be in contrast to say if I wanted to sell credit risk exposed bonds first. This really suggests I want to sell the bonds that are relatively more liquid in meeting redemptions, right? And as a result, the treasuries and the investment grade high quality corporate bonds were liquidated the most. Now, this concentrated liquidation in these liquid assets also had an aggregate effect on asset returns. Here, I'm just plotting the 4 quartiles of yields for treasuries and corporate bonds respectively, where the quartiles are defined by mutual fund ownership. Okay, and you see that here the blue line, the first quartile, is the set of bonds that are most owned by mutual funds, and they experienced a larger increase in yields, meaning that this is consistent with mutual funds sold them by more, and hence them having a larger price impact. Okay, so in the aggregate asset prices, this has been reflected. And, the Fed did not just stand by. The Fed acted very quickly, actually, 3 times, once on March 15th, and then through another 2 corporate bond purchase announcements on March 23rd and April 9th. And what we find looking at these announcement effects is that it seemed that the announcement of corporate bond purchases was more effective at curbing fund outflows, at reducing fund liquidations of liquid assets, and in stabilizing liquid asset markets. And the reason that we think that this has happened is that the announcement of the illiquid asset purchases has basically told investors, it's going to be okay, you can stay with the fund, and fundamentals will improve, right? So it curbed the investor outflows from the onset. It avoided the liquidation of liquid assets from the outset, and that was more effective than, the purchase of liquid assets such as treasuries, after the fact that they have been sold. Okay, so with that, let me just end with one more note, as in, why did this happen right now? Why didn't it happen before? It's not like mutual funds have changed the technology. They've always operated like that, but they have become a lot larger. And this, we would argue, is the first crisis in which, this mutual fund sector has become economically significant. Okay, so for example, from 2007 to 2019, the AUM of bond funds has grown from $1 trillion to $5 trillion. Okay, and so we've been having a period of calm, and this was the first sort of stress test for them, which is why their actions was large enough collectively to have an overall impact on asset markets. Okay, and so, they don't have any direct access to central bank funding facilities. So one thought could be that going forward, maybe we should pay more attention to what the mutual fund sector is doing, and perhaps even consider offering support in one way or the other. All right, so that is what we do. We build on a large literature, and for the most part, we think that what happened in COVID is really an illustration of the financial stability implications of the mutual fund sector, and that their outflows triggered a concentrated sale of liquid assets, which in the end had a price impact. So we combine the wisdom of many previous papers, but we really find an event where really this took place. And this is new because, again, before, when it's been studied, the fund sector was just not big enough, right? And we think that going forward, likely we will see what we've seen this time around again, given that the fund sector is unlikely going to shrink, and given that we know probably, there will be other bad times in the future as well. Okay, so with that, let me show you some of the more detailed analysis we do. Standard data, Morningstar Crisp, security level prices from Trace, and bond yields, maturities, ratings, etc. Okay, so nothing special. But first, what we look at is this notion of liquidity transformation. Okay, so we actually have a measure that captures how much liquidity transformation there is at a given mutual fund, considering the entire asset portfolio and considering, the flow volatility on the liability side. Okay, so we have this measure here on the x-axis, and we look at how the pre-COVID liquidity transformation relates to the COVID period fund outflows. Okay, and it's not surprisingly, we have larger liquidity transformation and larger outflows suffered during this time. Now you may think liquidity transformation correlates with a bunch of other things, and now we control for a bunch of other things, and this table is larger than it should be here, and we still find that the effect of liquidity transformation is significant, and that economically a standard deviation increase in the liquidity provision index leads to a 0.8% increase in fund outflows. Okay, so big contributor in outflows. But that's not all. Right? So if there were outflows and funds sold their assets sort of proportionately, we shouldn't have seen this concentrated strain in liquid asset markets. Okay, so the second piece of the puzzle is then that, given these outflows, what did they sell? Okay, and so here we run regressions for, each type of bond classified by their ratings, how much their imputed outflows for the funds that held that bond, how that affected the amount of that liquidation. And we find that liquidation to outflow sensitivity is higher for treasuries, and it goes down the spectrum, roughly speaking, as we move down the ranking of ratings. Okay, so this is consistent with liquid assets being sold first. Okay, we zoom in a little bit now, first on treasuries. Right, so within treasuries, if you do the same thing, we run the same regression to understand the liquidation to outflow sensitivities. We find that on the run treasuries were more likely to be sold than their off the run counterparts. Okay, so you see a larger coefficient for on the run T notes relative to off the run T notes, larger coefficient for on the run T bonds relative to off the run T bonds. Okay, so within the treasury sector, this pecking order seemed to have held up as well. Now, one thing we wanted to further look at, though, is this sort of pecking order, or this ability to decide which assets to sell first. This should be something that only open-end active funds have, right? So if you're in an index fund, you're passive, right? You got to track the index, so you shouldn't be able to do this concentrated sale in liquid assets. Okay, so to understand that, we do the regression, but we add an interaction with rank, and this rank represents, if I am a liquid security, where I am in terms of liquidity relative to other securities in the funds that hold me. Right? So if I'm an investment grade bond and I'm in a high yield fund, I have a higher liquidity rank, right? Because I'm more liquid than all the other securities. If I'm an investment grade bond and I'm, part of a broader fund, right, where there's also treasuries, then my liquidity rank is not so high. Okay, and so what we find here is that there is a positive significant coefficient on this interaction term, meaning that if you are a security that is ranked higher in the liquidation rank relative to other securities in the funds, then you are more likely to be liquidated. Okay, and this again is only the case for open and active funds. If that is, you're a more highly ranked bond in an open and passive fund, the same, interaction effect is not significant. Okay, so this tells us really that if funds were able to control the order of liquidation, they would have used more liquid assets as liquid buffer. But if they were constrained, of course, that is not something that they could have done. Okay, but it's really the active fund sector then that is driving these results. Okay. All right. So with that, we wanted to look at the price impact. Did all these outflows and liquidations actually have an actual impact on asset prices? Okay, and so the first regression here is very similar to Koval and Stackert and Lowe in the literature, where we look at for a given security, how the return of that security is related to the imputed outflows, right? So let's think of this is the average outflows at the funds that hold that security. Okay, now we also wanted to modify this measure by introducing a liquidity adjusted outflow, right? Because we have just learned that outflows don't affect all securities in a fund equally, right? The fund is choosing the more liquid assets to sell first, which means that for a same outflow, the liquidation rank of the security matters. Okay, so the liquidation adjusted outflow is basically adjusting the outflows to the funds holding that security with that security's liquidation rank relative to other securities in the fund. Okay, so this is should be a sharper prediction of which securities are liquidated and which securities have asset pricing implications. All right, so let's take a look at the results. First, this is just the standard imputed outflows. And here we see that in the Treasury bond off the run market, a 10% increase in outflows is leading to a drop in returns of 10 basis points. Okay, so this probably is also not surprising because the strains in liquid asset markets were mostly concentrated in the Treasury bond market, and off the run markets are more illiquid, so the price impact there is larger. Okay, now for the liquidation adjusted outflow, okay, we again find a significant coefficient in the Treasury bond market, but here notice that the effect is much larger. Right, for a 10% increase in the liquidation adjusted outflow, now we have a 33 basis point drop in daily returns. Okay, and what this means is that adjusting for the pecking order is making the price impact more sensitive, or in other words, the pecking order must have hold for this effect to be more sensitive than the just pure vanilla outflows. Okay, now for corporate bonds, we can do the same thing, and here I know it's a bit more tricky because obviously some companies were affected by COVID. So, we look at some specifications that are very restrictive that look at, within the same issuer, within the same maturity, within the same rating, right? How does mutual fund outflow affect asset returns, right? So, and this prevents, sort of credit risk exposure from affecting the result. Right? So in that narrowly specified bucket, we find that a 10% increase in outflows leads to a 20 basis point drop in daily returns. Okay, and this, even if you relax some of this still holds, but here in the fourth column, we want to be really sure that we're not picking up something else. Okay, now similarly, we can look at the liquidation adjusted outflows, which again should reflect whether, say, the investment grade bond is at the beginning of the pecking order or at the end of the pecking order. And we find that here, everything remains significant, but the magnitude of coefficients have increased. Okay, so now a 10% increase in the liquidation adjusted outflow leads to a 47 basis point drop in daily returns, right? Which is more than double of that of the pure outflows to begin with. Okay, so taken together, we think that it's the outflows coupled with the pecking order that led to the price impact. Okay, and now, as mentioned before, the Fed stepped in. Okay, on March 15th, there was the announced purchase of treasuries. March 23rd, the announced purchase of investment-grade corporate bonds. And April 9th, the announced extension purchase of corporate bonds, which includes fallen angels in that time period. Okay, and we find that the corporate bond purchase announcement had a significant effect in curbing fund outflows, whereas the treasury effect was not as safe. Okay, and we have some more additional analysis in the paper, but basically we think that it's the announced purchase of corporate bonds that assured investors that the future fundamentals of the fund are going to be okay, which stopped their outflows and prevented the asset liquidations from continuing. Right? And this is a little bit harder to imagine for the treasury purchases, which I'm sure had other implications, but for the corporate bond funds, it just wasn't able to assure people, and hence it couldn't stop outflows and it couldn't stop asset liquidations from happening. Okay, I think I'm out of time. So let me just quickly conclude. If you think it's the pronounced selling pressure of liquid assets by in fixed income corporate bonds that have contributed the strains in these liquid asset markets. Okay, the Fed interventions helped quite effectively, but it's the announcement of corporate bond purchases that were the most effective. And going forward, we think that it could very well happen again because the mutual fund sector is increasing. Actually, they're becoming more illiquid and they're transforming more liquidity as we speak. And so in the future, maybe that could trigger us to think about what the central bank may do to help stabilize liquidity transformation by mutual funds, but also to stabilize liquid asset markets going forward. Thank you very much.
Thank you, Yiming. Really, really interesting. Your discussant is Caroline Sissoko from Bristol Business School. Caroline, over to you.
Great. Can you see the screen? Can you hear me? Okay, great. Well, thank you very much for having me discuss this paper. It's a topic that I, love. So I am, very pleased to have read the paper, and really getting into the details of it was, absolutely fascinating for me. I'm probably going to go a little fast because I have a lot to say. This is the overview. Yiming covered it so well. I'm, not going to spend any time on this except to say I love the fact that you're looking at asset pricing implications, because I think those are the connections we really want to be making with this. I'm going to be looking at, the 4 key points of the paper and making comments on each of these points. The first is that the fund outflows were more severe for funds with more liquid assets. The second, that funds chose to sell more liquid assets first, or the pecking order. Third, asset prices were affected both by fund outflows and by liquidation policies. And then the Fed intervention on April 9th in particular reversed fund outflows and supported asset prices. So I'm going to look at each of those points. The first one, you have clear evidence of the fact that fund outflows were more severe for more liquid assets. The only question I had about this section was, you look at passive funds specifically when you're looking at the next step, pecking order liquidation. I kind of had this question: do passive funds face the same propensity to runs from investors? I mean, are investors leaving the funds as much as actively managed funds? As a policy issue, that actually kind of, might be an important aspect to look at and to evaluate. Let me go on. So then, the next thing is, this is about the pecking order sections. You are starting out with a claim based on a model that it's optimal for the funds to minimize price impact. And, of course, you've got a microeconomic approach. Diamond did VIG. You make a really strong assumption about, treasuries always being, more liquid in a very constant way. And I mean, just in terms of this optimality of this as a decision by mutual funds, I'd kind of encourage taking a more Keynesian macroeconomic approach and recognizing that liquidity is inherently limited for all assets. And as we learned in this crisis, treasuries count. So I think, the idea that it's optimal, that pecking order liquidation is optimal, it depends on what model you're using. And a macroeconomic view might throw that into question, just as you are essentially showing us in your paper. And I'd also encourage a more cynical view about what's going on here with mutual funds. And in particular, this is part of the legal literature, but Katerina Pastor has been pointing out that an important goal of financial industry lawyers is actually to design assets that optimally exploit central bank liquidity support. So, and that's of course for profit. So, pecking order liquidation can be part of that process. And of course, if it had been illiquid bonds that had crashed in value, there probably wouldn't have been a policy response. So I just kind of want to push back at some of the framing here. And I think this does lead to the possibility that you have different policy implications, such as would a requirement that, if outflows force liquidation beyond some threshold amount, asset liquidation must be proportional, more like index funds. That you could think of kind of policies that might be different from just central bank support. All right, got a lot to say, so I'm going to go fast. A modest liquidity ranking or pecking order. You established really clearly that treasuries were liquidated before corporate bonds. I wasn't so sure that the evidence across corporate bonds was completely solid. And in particular, like would Table 6 still have had significant effects if treasuries were omitted and you're just looking across corporate bonds? You know, I was kind of wondering that. Looking at this liquidation outflow sensitivity, one of the things that I noticed, I mean, so you can kind of see how in the investment grade mutual funds, there's kind of this clear upward tendency for this liquidation ranking, but it doesn't seem so clear when you're looking at the high yield and bank loan segment of it. And in particular, like here, these guys seem like they'd almost be an equivalence class across the B and the BB funds. So, you know, there seem to be some things that make you a little more dubious. It's not quite as strong, I think, as maybe a pecking order, but there's definitely a liquidity ranking. I'm going to go on. The other thing is that while you got stronger evidence for treasuries in the pecking order aspect of things, you have weaker evidence about the treasury flows with your price effect, right? And you know, your evidence for corporates is great, right? The evidence for the treasuries are actually insignificant except for off-the-run bonds. And I'm going to actually say that it looks like the mutual funds pulled the liquidity out of the treasuries first. They set up the environment for treasury dislocation, but maybe not actually causing the key dislocation that we think of. And so this is the chart I think of. So these are the market-wide yields of 30-year treasury bond, the 30-year treasury bond yield and the 10-year treasury note yield. And you know, March 9th is just that key date where, whoa, the reverse liquidity thing, that's where things flipped for the long treasuries, right? In a market-wide sense, when we look at what's going on with your mutual fund data, it starts at the end of February. And I think that's a really, really interesting thing. I think it probably explains some of the reason why you're not getting good price effects in when you run your regression, because the mutual funds seem to be pulling the liquidity out of the treasury market first, right? And they're setting it up so somebody else can have a big effect, is what I would say. So very important as part of the story, but I think there's a really clear reason here that you're not getting strong price effects on treasuries. You know, even though I think mutual funds have, you have a lot of evidence that mutual funds were important, but the timing issue is really interesting here. Then also, I want to ask whether your focus on April 9th is justified. I'd also point out the March 23rd announcement, I think also had an announcement of unlimited purchases of treasuries, so it wasn't just a corporate announcement. But more than that, you're looking at these one-day event windows of announcement effects for March 16th, March 23rd, and April 9th. And I think you find that March 23rd significantly increased outflows and April 9th decreased them. And given figure 7, it seems like there's something else going on here. Whoops, here, sorry. And that's just like when we look at what happened in March 23rd, like the long run effect seems to have had an effect on turning around the outflows for all but the bank loan funds. And then, you know, I don't know, I'm looking at this, it just makes me a little doubtful about this focus on April 9th. So maybe if, you know, you can explain why you really think that your announcement window analysis is the best way to look at this and to really capture things. That's something I'd like to understand better. And then when we look at table 11, I'd also say that, you know, what it looks like what's going on is that government investment grade and high yield fund price effects were actually different when we look at the price effects of the announcement effect. And in particular, when you do the issuer time fixed effects, where you're going to actually capture the different types of funds, because of course they're investing in different types of issuers, you know, you get a flipped result on March 23rd. Significant, but now it's the opposite from all of your other measures there where you left out the issuer fixed time effects. And I just say, so this is a map of the, you know, global bond yields where the bottom is your 10-year treasury, 30-year treasury, next are investment grade, and last are high yield. And as you can see, kind of looking at them at the different announcement dates, they're different, right? I mean, we have different things going on at these announcement dates with the different groups. And for that reason, I would say that, you know, you should really be focusing on your issuer time fixed effects results. Like you should be taking into it, you know, when you discuss it, you should be focusing on what's going on where you take into account the fact that these are actually behaving differently, right? And then you get that the March 23rd announcement is also something to pay attention to, which I think is very consistent with like our general picture of what we see going on. And yeah, so I would just encourage your discussion to focus more on that particular regression there. Overall, what would I say? I'd say the paper shows really wonderfully that mutual fund flows play an important role in the March 2020 market stress. Treasuries were liquidated first. They drew liquidity from the treasury market, but they occurred in part prior to the worst treasury market stress. Corporate bond liquidations started lower and were really closely correlated with price impact. That's just your chart that you already showed. What do you not do? I think treasuries sold by mutual funds only accounted for 30% of sales in March 2020. So they're an important part of the story, but maybe not the whole story. Claiming that the magnitude of the phenomenon is unique to mutual funds seems strong. Hedge funds could have accounted for 22% of March sales and possibly even more if some of the rest of the world sales should be included. Sovereigns may have played a role. So I don't think your paper really explains what happened to long treasuries after March 9th, and that you probably, there's a room for it to be setting something up for other players to have a big role. So I would just kind of look at a more complex story. But I mean, it's amazing to have this chunk of the story. That's just looking at that again. When it comes to policy implications, like I said, I think your emphasis on the April 9th announcement is a little bit too strong. Your argument seems to rely on the claim that the pecking order liquidation by bond mutual funds is optimal, which again, I'm just not so sure about that from a macroeconomic perspective. And I think there's a broader issue here that's worth raising, and is this how our market should be constructed? So the tendency in the finance literature to look at the existing financial structure and kind of treat it as done deal, this is what it is, we got to stabilize what we've got instead of evaluating it critically. I kind of have some problems with that because, it's like the economists are treating financial evolution as something we can't change. Craig Cairong likes to say it's the toothpaste that can't be squeezed back in the tube. Lawyers, in the meanwhile, are busy actively transforming the financial sector in the interest of their clients. They're increasing the share of income that flows to finance because that's their job. They're hired to make these things happen. So I would kind of encourage for policy implications to be a little broader and a little more critical of what's going on. But I love the paper, and I'm going to make an ad for looking at the legal side of things a little bit more in Catalina Pistor's Code of Capital, because I do think when you're working on these things, kind of taking a bigger picture view is also really useful. But yeah, thank you very much for a paper that I think really helped me understand what mutual funds were doing in this crisis. Okay. Hope I didn't take
Thank you very much, Caroline. Yeah, no, you were perfectly on time, almost exactly 12 minutes. Yiming, do you want to quickly respond?
Sure. Thank you so much, Carolyn, for the comprehensive and insightful discussion. I tried to take some notes, but they had so many comments. I don't know whether I got everything, but let me try. And definitely, we want to think more about what you suggested also afterwards. But this is what I thought for now. Okay, so regarding passive funds and outflows, so notice that the amplification of outflows is not due to the pecking order per se, right? The fact that bond funds had large outflows is because they had this liquidity mismatch, right? The fact that they had these very illiquid assets on the asset side, that after people take their money out of the fund, right, on the liability side, that funds would sell these assets at a discount, but that discount is not immediately reflected in the net asset values. And it is that stale net asset value that encourages everyone to be the first mover in taking their money out, and that is what's amplifying outflows. So passive funds, if they're holding illiquid bonds, would have the same problem. Actually, they would probably even have more of this problem because they cannot choose to use the lower discount assets first. So it's a stale NAV, it's a liquidity transformation that led to these outflows. Okay, now related to discounts, to your second point, so you're absolutely right? The notion of what's a liquid asset or what's a low discount is completely dynamic, right? I think of this as, you have a market, asset market. I'm the first guy to sell a treasury. That should be fine, right? There's no more strains. It's going to be a buyer. But then more and more people sell an asset, right? And then the dealers can't swallow all that inventory, or there's not enough people on the other side to buy from the dealers. So you can think of the model or reality as a way in which mutual funds look at their assets and think, okay, what's the next best thing to sell, right? And at the beginning, we think of traditionally liquid assets like cash and then maybe treasuries. But in this case, for example, so many mutual funds sold treasuries that the treasury market themselves increased in illiquidity. Okay, and luckily that stopped because of Fed interventions. But we could imagine a world in which if so much in treasuries have been sold, or so much even in investment grade corporate bonds have been sold, that at some point the traditionally liquid assets would have a discount higher than traditionally less liquid assets. Then they would immediately look and sell the most liquid assets in that time period, which may not be ex ante what we think of a liquid asset. So we think of liquidity, but what the model is suggesting and what we think should be happening in reality is that funds are looking at what they have and picking what at that time is going to give them the lowest discount. And the problem came in exactly because everyone held these treasuries and these investment grade corporate bonds thinking, oh, this is going to be fine. But if everyone was selling them collectively, it could be that these liquid asset markets are becoming actually illiquid. Right? So there's nothing in the model that would prevent them from doing something optimal, which is to choose the lowest discount to sell. In terms of price impact, so similar to what I just said, right? The fact I choose to sell a treasury first doesn't necessarily mean that that first sale has a price impact, right? It has to be that the market becomes sufficiently illiquid that that sale then triggers a price impact. Right. So therefore, we don't think that, that we don't find any price impact in the treasury note market, that implies that the funds didn't sell treasury notes. They did. It's just because the market was still liquid, and hence their sale, the individual bond sales, did not have at the individual bond level any price impact. I also just wanted to note, that table where we look at the treasury bond versus note results. That table's result that the price impact were concentrated in treasury bond markets is quite consistent with what people have found in COVID-19, where it's really the 30-year treasury bond that was the most impacted, right? So if you look at Stefan Nagel, Zhao Gangsong, and Zhi Guohe, their paper really suggests that in this time, it's really the longer end of the maturity that was the most concentrated. I will also note that, the results are within maturity bucket. They're within, lots of these little fixed effects. So what you want to interpret the results as is not the overall impact. It is comparing treasuries of the same maturity, of the same type, right? Do those that were sold more by mutual funds have a larger price impact? Now, this fixed effect helps us to, control for, say, changes in the yield curve. But what it also does is absorb all the shocks, all the price impact that are common to treasury notes, that are common to treasury bonds of a given maturity altogether. Right? So that leaves us with this conclusion that at the individual bond level, okay, this is what we find, but the broader aggregate impact could be much larger than what we find, meaning that funds could have had an aggregate impact on treasury notes. They could have had an aggregate impact on the run treasury bonds, right? But that is sort of absorbed by the fixed effects that we use. Okay, and then central bank intervention. So actually, no, I forgot one point. So pecking order. So you're right. In that graph, we're sort of plotting investment grade and high yield together. What happened is that, there are high yield funds and investment grade funds. So the reason why those liquidation to outflow sensitivities are a little bumpy is because we're basically lumping, two sets of agents together, right? So if we were to plot that graph separately for investment grade and high yield funds, the slope would be a lot smoother. But you're also right, I think in the high yield segment, we also see some bumps because there the credit risk concern relatively becomes more concern. Okay, now to, what the Fed did. So you're right, you use a one-day event window. And actually, we did try extending that event window. And indeed, we find that for March 23, if you extend it, say, to a 3-day or a 5-day, the flows start to react. Okay, and that could be quite plausible because these are partly retail funds. So maybe it takes some time for investors to respond, for the outflows to stop, and for the asset pricing implications to take effect. So we're not saying March 23rd was working in the opposite direction. We just think that the April 9 had a sharper effect, or had a faster effect. But if you do extend the sample, then also the March 23rd one helps to curb outflow. So our main distinction in the policy section, we think there is a big difference in what the Treasury purchase announcement did and what the corporate bond announcement did. And then maybe also on that note, what we saw in this time is that it had an effect. But to your question, going forward, it's definitely important to think about whether we should just do this all the time, because now if there is an expectation that this is being done by the Fed, then maybe it will affect what the funds are doing in choosing their assets, what they're doing in managing their portfolio, right? So the moral hazard concerns are definitely very important to consider. And that, is outside the scope of the paper, but I think that's definitely very important to keep in mind going forward. So that's all I remember, but thank you so much. And I'll take a closer look at the slides and think more about how to improve the paper. There are a couple of questions. Let me just go maybe very quickly. Funds with sponsors and funds without sponsors. So I think that's a great point. I don't know where the data is, and I would love to maybe ask Angela more for how we potentially could find that out for the US and maybe look at that dimension. The ECB in Europe, okay, so in Europe, finds that funds with more assets eligible for a central bank purchase perform better. So we don't test this ex ante. So what we have is exposed the announcement effect shows this. I don't think this, it looks like there were anticipation effects. Probably that's related to the fact that, this announcement of corporate bond purchases this time around is really unprecedented. So perhaps people didn't expect, and hence, the funds didn't experience the benefit until the policy has happened. And then Laura has a question in the Q&A of what the advice of the SEC would be after all this has happened. And this is the big question. I think broadly, it seems that if there is something that we can do to prevent large and amplified outflows, that is really the starting point of everything. So having floating NAV, with spring pricing seems to be sort of a first best, right? Because then, you don't have these large outflows. You don't need to hold such a big liquid asset buffer. And then you won't have the big impact on these liquid asset markets that are comprising your liquid assets. But if swing pricing is insufficient, I think what we learn is that you want to hold liquid assets, traditionally, say cash and treasuries, and investment grade corporate bonds, but that how much you're holding should depend on how much other funds are holding. And that funds should be aware of that, this market for liquid assets is dynamic, and that it could have externalities on each other and other funds. Is that? Thank you very much.
So I think that brings us to a close of the session. Thank you very much to all the speakers, the discussants, the presenters. I hope you enjoyed it as much as I did. And maybe I'll see you next year. Thank you very much.
Thank you very much. Thank you.
Thank you.